All righty. Welcome everyone to the Hurley Investments. What is a long call option? My name is Kevin Hurley. I'm going to spend a little bit of time with you going over a simple option instrument that can replace stock ownership. As we take a look at the long call, it's obviously an option. This option, plain and simple, is a derivative. It's going to drive its price based off of the stock that's associated with. There are some gamma, beta. I'll do a Greeks video for you. Make sure you look for that one down the road. But primarily, the option's based on the potential stock price and the potential movement of that stock over a period of time. An option in general is a contract that gives the purchaser or seller the right or obligation to sell or buy the underlying stock at a predetermined stock price for a predetermined period of time. Buying an option is a right. When you buy an option like we're going to do with a long call, you're purchasing the right to do something. If you're to sell an option, it's an obligation. Although it's often used as stock ownership, you can use options by themselves. Something to remember about options: one option contract controls 100 shares of stock. With that said, let's jump into the call option. This is primarily the long call. Again, it's that derivative that's based on that stock ownership. Plain and simple, the purpose of a long call or the call option is to buy or have the opportunity to buy stock ownership at a lower price than it'll be trading in the future. I'm going to show you an example of Apple as we go through, but you're making a bullish bet on this stock. As you purchase this option, you're going to have the right to buy the underlying stock at a predetermined price for a predetermined period of time, which means in that certain period of time, you think the stock is going to move, usually pretty quickly or aggressively to the upside. This is obviously a bullish trade. You're looking for an indicator, an event, a new product out, sales, earnings, something that's going to move the stock, I want to say violently upward, but a catalyst that'll move it higher. Just to remember, one call option controls 100 shares of underlying stock. If you wanted to buy 500 shares of Apple using the call option, you'd have to buy 5 option contracts. A call option is typically referred as to a long call, and it's a buy to open position which will create a debit into your account. You're going to pay money for the premium of buying this option. Now, the beautiful thing is, I told them to use Apple. Apple in this particular position or this particular chart is trading at $225 a share, basically. Really, it's $224.59. After hours, it's $225.12. I would consider Apple a rather expensive stock. If you are going to buy 100 shares of Apple at $225.12, that would be a capital commitment of $22,512. That can be rather expensive for 100 shares of stock. So you have this option, the long call option, right? Long call on the left-hand side of your option chain. Up above under our new red box, you're going to choose the time frame that you'd want to purchase this option. For me personally, if we're going to do this today, here at the beginning of October, I'd be looking at a 45-day trade going out to November. I want to give you the opportunity to have a pre-earnings run. The earnings is here in the end of October. I think it's October 30th. I might be able to sell this option for a profit before I even go through earnings. But the pre-earnings run, the earnings catalyst, here in September, they had their new iPhone 11 release. So they're going to have a product that's out there. There's a couple catalysts here saying they're going to go higher. I'm going to look at my strike prices there in the middle. For me, the best bang for the buck, or the strike price I would probably choose, is $225. The reason why, it's close to the actual price that the stock closed at today. It's even a little bit cheaper than its extended hours pricing. So as I look to what I'm going to do, I'm going to use an option price. When you always buy an option, I'm going to go to the ask column, and I'm going to spend $9.10 per option. Obviously, one contract will have 100 options in it to cover 100 shares of stock. As I take a peek, I could go at a higher one or I could go at a lower one, but usually at the money is going to be your best bang for the buck. If you go higher, you're trying to be cheaper, which means the stock has to move. You know, if you chose a 230, it has to move $5 more till you're in the money or have a guaranteed profit on that position. If you go lower, you're probably overpaying for the opportunity to buy it maybe at 220 when it's trading at 225. Plain and simple, if you're going to buy the position, you're going to use the ask column prices. If you were to buy it and you want to sell it for a profit, you're going to use the bid column. If I was going to buy the long call, I'd go really quickly over to the ask column. I'd head down to that $225 strike price. It would cost me $9.10 per contract. Again, each contract has 1,000 options in it. To sell a closeout, I have to go to the bid price. If you notice, the bid price right next to the 910 is $8.70. There's a 40-cent spread, a 40-cent difference. This prevents me from buying it and selling it and day trading it right away. This also, the spread is what gives the market maker or the owner of these shares the ability to make a little money as they're facilitating the buy and sell of stock positions. If I was going to buy a long call, it gives me the right to buy the stock at a strike price for a certain period of time. I'm choosing 225, thinking the stock might go up to 250 with its earnings coming up here at the end of October. What am I going to pay for it? Well, one contract, 100 is equal to 100 shares. So it's $9.10 per option times the 100. It cost me $910 to control or to have the right to buy Apple at $225. Much cheaper than the $22,512 to actually outright go buy the stock. Now I've got to break even. For me to guarantee a profit here the third Friday of November when this option expires on our monthly options, the stock has to move roughly $9.10. My break even, I'll make a profit anything above $234.10. If it does move up to $250, for every $9.10 I spent, I'll make $15.10 or to $15.90, excuse me. That'd be pretty cool. $15.90 would be like 150% return on my option. Significantly better than if I just made, $225, $25. If I made $25 in the stock going into $250, it'd be like a 10% return. Whereas if I use the option, I can make 150% return. Now the risk in this trade is the net debit. If I bought one contract and Apple goes down to $200, I'm not going to want to buy it at $225. I will lose my $910. That is the risk in the trade. But that's much better than losing $25 a share times 100. I could lose $2,500 if it went down to $200 a share. I hope you enjoyed the long call option. If you have questions, feel free to get a hold of us at our phone number. You can email us at support@hurleyinvestments.com. Go to My Hurley Investment to see a bunch of other videos we have out there, or follow us on our YouTube channel. If you do follow us on YouTube, click the subscribe button. Make sure you click on the bell so you'll hear every time we release a new video. In all reality, we're just real world investing knowledge from real advisors trying to help you guys out. Another way to say it, we're just here to help real people make some real money in the stock market. Look forward to having you attend our next video. I'll see you then.